Okay, let's dive right into this explainer. We're going to look at how a single, massive technological leap is sending absolute shockwaves through the entire global economy. Right now, we're watching this truly fascinating chain reaction unfold, where advancements in artificial intelligence are doing way more than just changing our software. They are actively rewriting the physical supply chain of the whole world.
To really understand our 2026 economy, we've got to start at the epicenter. We are in the middle of a global memory supply shortage so severe that the media has literally dubbed it RAMmageddon or the RAMpocalypse. And what's absolutely wild about this is that unlike those pandemic-era chip shortages caused by supply chain breakdowns, this crisis is entirely driven by strategic, intentional choices. Manufacturers are deliberately chasing the massive profits of the AI boom, and, well, it's leaving pretty much everyone else scrambling.
So here's how we'll trace these ripples today. We'll start with the RAMmageddon crisis, move over to the AI catalyst, look at the equipment investment boom, check out those surprising display delay ripples, and finally wrap up with the commodities and industrial impacts holding it all together.
All right, Section 1, the RAMmageddon crisis. Let's look at the sheer scale of the semiconductor supply shock.
What's truly staggering here is the 200 to 400% price escalation we're seeing in everyday computer memory. Because manufacturers are diverting practically all their resources to AI, standard consumer memory has become incredibly scarce. And this has a very real-world impact. PC manufacturers are suddenly seeing their component costs increase by up to 15 to 20%.
So how exactly do we get here? Well, it was kind of the perfect storm. Back in 2022 and 2023, during a market downturn, giants like Samsung, SK Hynix, and Micron made these strategic production cuts to stabilize their pricing. But then they collided head-on with the explosive 2024 generative AI boom. Demand skyrocketed exactly when supply had been artificially tightened, leading us straight into the severe 2025 and 2026 shortage we're dealing with today.
Moving right along to Section 2, the AI catalyst. The crucial point here is understanding exactly what is eating up all this memory capacity. Why is AI so hungry?
The culprit is high-bandwidth memory, or HBM. This is a highly specialized type of memory used in AI data centers. And the kicker is that it requires significantly more wafer capacity per bit to manufacture than your standard consumer RAM. Manufacturers are aggressively pulling their fabrication lines away from the memory that goes into, say, your smartphone or your laptop and dedicating it to HBM to fulfill these massive, incredibly lucrative contracts with AI infrastructure providers.
Now, to put this AI appetite into perspective, this data point absolutely blew my mind. OpenAI alone is reportedly consuming roughly 40% of the entire global DRAM supply. Think about that. Just one company's infrastructure demands are eating nearly half the pie. That leaves the rest of the world, literally every other tech company, PC maker, and smartphone manufacturer, fighting tooth and nail over the remaining 60%.
Naturally, the industry is scrambling to respond to this bottleneck, but, hardware solutions take time. Micron recently broke ground on a massive $9.3 billion fabrication plant, but that won't even start production until late 2028. In the meantime, we're seeing software solutions step up to the plate. Take Google's new TurboQuant technology, for example. It impressively claims to compress memory needs by up to 6 times for large language models, desperately trying to ease the strain on our physical hardware.
Which brings us to Section 3, the equipment investment boom. This desperate need for new factories is triggering an absolute gold rush in the equipment sector.
According to the latest July 2026 forecast from the Semiconductor Equipment Association of Japan, or CAIJ, the frantic rush to build out AI infrastructure is triggering a massive investment surge. All those brand new fabs need highly specialized, highly expensive equipment to actually manufacture advanced logic chips and HBM.
And the growth projections here are just massive. The SEJ forecasts that sales of Japanese-made semiconductor manufacturing equipment will surge 26% to a staggering 6.55 trillion yen in 2026. And they honestly don't see it stopping there. They project it's going to climb to 7.40 trillion yen by 2027 as new fab buildings are finally completed and ready for equipment installation. The insatiable appetite for AI servers is directly fueling this massive industrial machinery boom. Now, here's where things get really fascinating. Section 4, the display delay ripple. This is where we start to see the surprising downstream effects hitting seemingly unrelated tech sectors.
We are looking at an incredible divergence in the data. While semiconductor equipment is booming at that plus 26% rate, flat panel display, or FPD manufacturing equipment, is actually contracting by 5%. You'd normally think a tech boom lifts all boats, right? Well, that is definitely not what's happening here.
The billing forecasts confirm this slump, showing FPD equipment sales remaining heavily subdued at 342 billion yen for 2026, and even dipping slightly into 2027, before we see any projected recovery in 2028. But wait, why on earth is display manufacturing stalling while chip manufacturing explodes?
The CJ report explains the exact mechanism of this domino effect, and it's brilliant. Step 1, RAMmageddon drastically spikes the cost of memory. Step 2, PC manufacturers, who are suddenly forced to pay 200 to 400% more for RAM, watch their profit margins severely deteriorate. Step 3, to save money and keep their laptops at consumer-friendly prices, these makers are abruptly delaying their planned upgrades to premium OLED screens. Because memory is so absurdly expensive right now, the shiny new display just gets chopped right out of the budget. So, hey, if you were hoping for a cheaper OLED laptop next year, you can literally blame AI servers for the delay. It is a perfect, real-world example of a zero-sum game in global manufacturing.
All right, let's step even further out. Section 5, Commodities and Industrial Impacts. Let's look at the outer edges of our economic pond to see how traditional metals and industrial transport are behaving in this bifurcated, AI-obsessed economy.
A July 2026 technical analysis from the commodities firm Gia Catloy points out that despite the massive digital tech boom, physical industrial metals are currently facing a lot of downward pressure and consolidation. For instance, silver has dropped below $59 an ounce. This is mostly being driven by broader macroeconomic factors, lingering inflation fears, a 78% probability currently priced in for a September Fed rate hike, and ongoing geopolitical tensions in the Middle East causing energy cost fluctuations. So while silicon is basically gold right now, actual physical commodities are kind of treading water.
So, with tech flying incredibly high and raw metals consolidating under all this macroeconomic pressure, it begs a really vital question. How is the physical infrastructure of our economy, the actual tangible backbone that moves these materials around, holding up?
Well, looking at GoTrade data for CSX, a massive American railroad and freight company, the answer is surprisingly well. Their stock is up over 46% year-to-date, currently trading around $52.87, with a massive market cap nearing $93 billion.
Financial analysts are pointing out that CSX's recent Q2 earnings and revenues actually beat Wall Street estimates, and this sends a super bullish signal. Even as digital AI models completely consume the world's attention in memory chips, the physical economy, the literal trains moving the heavy equipment to those new $9.3 billion fabs and transporting our basic goods, remains highly robust and incredibly profitable. So as you digest how a single AI trend can completely consume global memory, skyrocket your PC prices, and literally delay the OLED screen on your next laptop, yet contrasts so sharply with the steady beating heart of railway stocks, ask yourself this. In an increasingly hyper-digital world, where does true economic value actually live? Is it up in the cloud, or is it down on the tracks? Thanks for joining me for this explainer today. I really hope it helps you see the invisible threads that are connecting our global economy.